Welcome to Breaking News to Trading Moves. Welcome to the debate. Today, we're asking a very specific, critical question about retail trading psychology.
Yeah, specifically, when your brain is literally, biologically, hijacking your logic, can a simple, structured, self-written journal actually save your portfolio?
Exactly. Or, on the flip side, do you need a machine to basically lock you out? I'll be arguing that structured pre-trade written reasoning actively forces a cognitive pause. And that pause intercepts impulsive trading loops and, builds real internal resilience.
Right, and I look at it from a completely different angle. I contend that our physiological stress responses, combined with the brain's tendency to just rewrite memories, render retrospective journaling totally ineffective. We need proactive systems that intervene with cold arithmetic, rather than, relying on human willpower.
Let's lay out the foundation here. I view a proper trading journal as a reasoning document. We aren't talking about a diary where you just write down your wins and losses at the end of the month, right? The act of writing actually intercepts the impulse loop.
And when you say impulse loop, you mean?
I mean the cycle of seeing a market movement, feeling an emotion like greed or panic, and immediately clicking buy or sell. Writing forces a physical and mental detour.
Okay, but
Think about a specific rule, like requiring a trader to write 3 distinct reasons a trade could fail before entering the position. That forces the trader to articulate the why before any money is actually at risk.
sure, but let's put that in a real-world context.
Absolutely. I mean, we've all been there with Apple stock. You buy 200 shares at $185 based on a bullish earnings thesis.
Right. You look at the chart, you calculate the risk, and you swear your hard stop loss is $182. Then the market opens, and it hits $178. What happens in that exact moment?
Panic. Well, your mental anchor is still tied to your entry price of $185. Because of that anchor, $178 suddenly feels cheap instead of dangerous.
Right. The internal narrative changes from, I'm wrong, to, oh, this is a bargain.
Exactly. You ignore the stop loss entirely. Instead of exiting, you add 100 shares to average down your entry price. But the trend is broken and the stock plummets to $170 over the next 2 days. You finally capitulate, panic, and sell everything for a $3,750 loss.
Ouch. Yeah.
If you had a written pre-trade plan forcing you to honor the original stop, that loss would have been capped at $600. The written word holds you accountable to your past rational self. It prevents a small paper cut from ballooning into a catastrophic injury.
That makes logical sense on paper, I'll give you that. But it completely ignores the physiological reality of trading. I mean, have you considered general adaptation syndrome?
You mean the body's biological stress response?
Exactly. It is your body's alarm system. When you watch that Apple position break through your stop loss, you weren't operating in a vacuum of pure logic. Trading stress releases glucocorticoids, specifically cortisol and adrenaline.
Right.
Your sympathetic nervous system hits the gas pedal. You are in a literal fight or flight response.
Which means the brain is prioritizing survival over math.
Precisely. Blood flow literally moves away from the prefrontal cortex, the part of your brain that handles logical planning and remembers those written rules you love, and it floods into the amygdala, the fear center. Traditional journals are purely reactive.
Wait, but
By the time you're calmly journaling, the financial damage is already done. You're placing the burden of discipline on willpower, and biology tells us willpower is a resource that reliably depletes and fails under extreme pressure.
okay, I hear what you're saying about the amygdala hijack. But let me explain how the cognitive pause of writing is the exact antidote to that biological response. The pre-trade entry field, where you write 1 or 2 sentences about the setup, the trigger, and the stop, takes exactly 30 seconds.
30 seconds is an eternity in live markets. When the tape is moving, 30 seconds feels like a lifetime.
But that is the point. Writing isn't just a recording task, it's a completely different cognitive process. Think about what happens in your brain when you write. You have to retrieve vocabulary, structure syntax, and move your hand to form letters or type keys.
So,
So that linguistic and motor processing forces blood flow back to the prefrontal cortex. You literally have to translate abstract, wordless panic into concrete vocabulary. You are forcing a physiological pause.
I see where you're going, but
It acts as a circuit breaker for those reckless boredom entries or the fear of missing out. By the time you finish the sentence, the urgency of the impulse has often peaked and started to subside.
okay, Dr. Freud, but I just don't buy that a 30-second pause is enough to override millions of years of evolution. I mean, how does that pause hold up against the affect heuristic?
Meaning how our current emotions color our decisions?
Exactly. It's the mental shortcut where your immediate emotional state entirely dictates your perception of reality. If you are stressed, a minor price dip looks like a total market collapse. If you are happy, a dangerous resistance level looks like a minor speed bump.
Sure. Drawing up a pre-trade plan for the market opens is like drawing a map in a quiet, well-lit room. Your heart rate is at resting levels. But trading live? That is trying to read that map while navigating a Category 5 hurricane.
That's a vivid analogy.
The wind is howling, the rain is blinding you, and you can't even hold the paper still. You can't even see the map because your biological state has altered your perception.
That is a fun analogy, but you're suggesting the map is entirely useless just because the wind is blowing.
I'm suggesting you're not even looking at the map. And let's look at the reverse of the panic scenario. Let's say you wake up to news that your portfolio is up $2,300 before you even finish your coffee. You are completely euphoric.
A great problem to have.
Right. But this positive emotional high artificially inflates your risk tolerance. You take 3 marginal, low-probability setups before lunch trades you would normally skip because you feel invincible. Will a 30-second writing exercise stop a dopamine-flooded brain from justifying a bad momentum trade?
Yes, it often does.
Rarely. The brain is too good at rationalizing what it wants in the moment. That's why I argue for active intervention systems. We need a machine, like an AI coach or an algorithmic hard stop that interrupts the user before the mistake repeats. We need systemic overrides, not a reliance on a 30-second pause.
Wait, hold on. A machine locking you out? I get the appeal of a safety net, but you're assuming the goal is to eradicate the emotion entirely. It's not.
It's not?
No, the goal is to measure it and manage it. This leads directly into the tension between relying on willpower versus relying on arithmetic. I defend self-reflection because tracking emotional states actively builds the muscle of discipline.
How so? Self-reporting is notoriously flawed.
Not when paired with hard data. Let's say a trader rates their emotional state on a scale of 1 to 10 before each session. Over time, they begin to correlate those subjective emotions directly to objective outcomes. Let's look at the herd mentality bias.
You mean following the loud crowd on Reddit or Twitter?
Right. Say a stock is trending online with 50,000 upvotes. The trader buys in at $38, entirely unaware the stock peaked at $41 2 hours earlier.
Yeah, they're just chasing.
Exactly. The risk-reward ratio is totally inverted now, but the crowd is euphoric, so the trader buys. They end up taking a $3,600 loss. Now, if they tag their trades in a journal as socially influenced versus self-generated, the written data reveals a glaring truth over time.
Which is?
If their socially influenced trades consistently underperform by 20%, the data itself commands them to implement a mandatory 24-hour cooling period for any viral stock. That builds long-term internal self-management. It's willpower guided by personal, empirical evidence.
See, you keep framing the problem around discipline and self-management. That framing makes the issue feel totally unsolvable for the average retail trader.
Why?
Because it turns trading failures into character flaws. It makes them think, if only I were more disciplined, I wouldn't have lost that money. I reframe the solution to pure arithmetic. Why rely on a human being to synthesize their own emotional scores and impose their own timeouts?
Because they are the ones executing the trades. They have to learn the hard lessons.
But they learn faster from objective financial feedback that doesn't care about their feelings. Imagine an automated system analyzing your broker data. After a bad session, an invoice literally pops up on your screen.
An invoice?
Yes, not a spreadsheet you have to open, but an intrusive alert that says, trading after a loss without waiting has cost you $1,840 across 6 violations this month.
Wait, a $1,840 invoice popping up on my screen? That's terrifying.
Exactly.
But, okay, I see your point. It makes the abstract concept of bad discipline brutally concrete.
It is terrifying, and that's exactly why it's effective. Seeing that exact financial cost removes the need for discipline entirely. When you frame trading errors as a lack of discipline, it's vague. When you frame it as, this specific behavior costs me $300 per incident, the hard math overrides the emotional impulse.
I don't know.
You don't have to dig deep to find the willpower to stop revenge trading. You just have to look at the bill your behavior just handed you. Arithmetic doesn't care about your emotional state, it doesn't care if you had a bad morning, and it doesn't require a 24-hour cooling off period to be effective.
I'm not convinced by that line of reasoning because it just treats the symptom. If I see that bill, I'm just mad at the machine. It doesn't explain how the market tricked me into the purchase. We're storytelling machines. This is where a strict journal protects against things like the narrative fallacy.
The tendency to construct coherent stories to explain random events.
Exactly. By writing the complete analysis before the outcome is known, you cannot fall victim to hindsight bias. Think about a gap-down scenario with Netflix.
Always a brutal scenario.
Right. Netflix gaps down 12% on a subscriber miss. It's a painful open. The position is deeply in the red. After the fact, when the trader is reviewing their month, their brain desperately protects its ego. The brain hates cognitive dissonance.
So it invents a story.
Right. So it thinks, I knew they would miss. The password sharing crackdown was obviously played out. I just got unlucky with my timing. They rewrite their own history to feel competent.
Because facing the reality that they just gambled is too painful.
Exactly. But if they have a strict pre-trade journal entry from the previous week, they are forced to confront reality. The entry reads, Netflix long, password crackdown adding 8 million subscribers, street estimates look totally beatable, sizing up.
Yeah, the ink doesn't lie.
Right. Hindsight aggressively rewrites memory to protect us from pain. Without the written record proving they had a structurally flawed, bullish pre-trade thesis, the trader falsely remembers knowing they would miss. They learn absolutely nothing. The written word prevents self-deception because ink doesn't change when your feelings do.
Well, that assumes the trader interprets their own written words objectively. Even with meticulous written records, traders constantly fall into the clustering illusion or the hot hand fallacy.
Meaning they see a winning streak and think they have some magical momentum.
Precisely. They think they're in a flow state. Let's say you've won 7 trades in a row, netting $5,600. Your journal accurately reflects these wins. You look at that pristine record and feel totally locked in. So for trade number 8, you double your position size from 2% of your account to 4%. You genuinely believe your baseline skill level has elevated.
But the statistical edge of their strategy hasn't changed at all.
Not one bit. A 7-win streak at a 55% win rate occurs about 1 in 100 sequences. It is entirely normal statistical variance. Trade 8 loses. Because you doubled your size based on a false narrative of being in the zone, the loss is $1,600 instead of the $800 it should have been.
But a journal,
Without an external system running objective pattern detection rules across multiple time frames, you will selectively interpret your own journal to protect your ego. You see patterns in random noise. You'll look at your journal and say, I'm trading great, I should size up. When a cold algorithmic coach would say, you are experiencing standard variance, maintain your 2% risk.
But an algorithm can't fix the trader's mind. You have to understand the hot hand fallacy conceptually to accept the algorithm's advice. If the AI tells you to maintain 2% risk, but you feel invincible, you're just going to click the override button anyway. This is why the cognitive work must be done internally.
I counter that the cognitive work is just too slow for the speed of modern markets. We are demanding that retail traders operate with the emotional control of a Zen master and the computational objectivity of a supercomputer. When that sympathetic nervous system fires up, the parasympathetic nervous system, the part that calms us down and restores rational thought, is literally sidelined.
Sure, but
We are fighting millions of years of evolutionary biology that screams at us to run from pain or attack when threatened.
I completely acknowledge the biological realities of the fight-or-flight response. The research on glucocorticoids and adrenaline during financial risk-taking is undeniable. However, neuroplasticity is also a biological reality.
Okay.
Through repeated, structured journaling, forcing the prefrontal cortex to articulate logic before action, we can literally rewire how we respond to those stressors. The cognitive pause isn't just a gimmick, it's a legitimate training mechanism for the brain.
A training mechanism that requires optimal conditions to function. You are asking a trader to train their brain while they are actively losing money. That is incredibly difficult, if not impossible, for the average person.
Difficult, yes. Impossible, no. Let's go back to the idea of tracking skipped trades, or FOMO entries. A trader sees a hot stock like Super Microcomputer rally 15% in 2 days. The anticipated regret of missing the move is excruciating.
Oh, the FOMO is brutal.
They want to buy at the absolute top of the range without a thesis, without a stop loss, and without a target. If their protocol requires them to log the trade and write down the justification first, they are forced to confront the blank page.
Right. The page demands a technical or valuation reason. Writing down, "I just don't want to miss out," looks utterly ridiculous when written in ink. That realization happening in real time is what stops the button click.
But what if they don't stop?
What do you mean?
What if the FOMO is so strong they click the button anyway, lose $2,400, and then feel too ashamed to even open their journal? This is the fatal flaw of relying on self-reporting. We see this in weight loss, we see this in budgeting, and we see it in trading.
Well,
The loss cycle begins. The shame prevents the journaling. Because they don't journal, they don't learn the lesson. Because they don't learn the lesson, they guarantee the very next impulsive trade. An external algorithmic system doesn't feel shame. It just logs the data, identifies the rule violation, and calculates the cost. It completely removes the emotional friction of self-reporting.
That's actually a really profound point. I have to admit, that's a tough hurdle. The journal requires you to sit alone in a room and face your own mistakes, to face your own lack of discipline. And human beings will do almost anything to avoid feeling foolish, including abandoning the journal entirely. I can see how a machine logging the error bypasses that ego defense.
Exactly. It doesn't judge you, it just bills you.
Right, but I still believe that emotional friction is the exact crucible where discipline is forged. Yes, it's painful to write down your mistakes, but that pain is the teacher. If we outsource our accountability to software that quietly logs everything in the background, we never build the psychological resilience required to be a truly competent trader. We just become reliant on a digital babysitter.
A digital babysitter.
Yes. We become button pushers obeying an algorithm.
I'd argue that becoming a disciplined button pusher who obeys an objective, mathematically sound algorithm is exactly how retail traders survive long-term. Human beings are exceptionally bad at processing abstract probabilities and exponential risks. We are heavily influenced by the framing effect.
The way information is presented changes our choice, even if the underlying facts are the same.
Exactly. If you present a trade to someone and say it has a 65% win probability, they take it eagerly. If you present the exact same trade and say there's a 35% chance of losing $500, they hesitate. The expected value is mathematically identical, but the loss frame activates our biological risk aversion. An automated system doesn't care about the frame. It only cares about the expected value.
Which brings us back to why the journal prompts are so vital. If you have a specific prompt that says, restate this trade's odds in both the gain and the loss frames, you are forcing the trader to actively dismantle their own cognitive bias.
That's a lot of work mid-trade.
By recognizing that the loss frame makes them hesitate, they learn to identify when they are being manipulated by framing rather than expected value. They are learning to think critically about their own thinking.
I agree that metacognition is the ultimate goal, but we disagree on the most effective vehicle to get there. Relying on a trader to play both the patient and the therapist simultaneously is a monumental task.
It is the defining task of the profession. Let me summarize my position in light of this entire exchange. Rigorous pre-trade documentation is not just about keeping a diary. It's really about creating a mandatory physical gap between an emotional impulse and a financial action. By forcing the articulation of risk, tracking the mental state, and documenting the thesis before the outcome is known, traders actively combat biases like anchoring, hindsight, and FOMO. This process fosters genuine psychological resilience, and it builds an internal accountability that, frankly, no external software can ever truly replicate.
And my summary is that,
we really must respect the profound power of human biology and our cognitive blind spots. When real capital is on the line, stress hormones dictate behavior far more than good intentions do. Relying on retrospective diaries places this unfair burden on willpower, which inevitably crumbles under extreme pressure. True behavioral correction requires objective, preemptive constraints and hard arithmetic, like a visible invoice for bad behavior, that actively interrupts the trader before the biological impulse can cause lasting financial harm.
Despite our different approaches to the solution, I think we have reached a clear point of convergence today. We both firmly acknowledge that raw trade trackers, software that merely logs your profit and loss and your entry prices, are entirely insufficient.
The mechanics without tracking the mind is just a half measure. True improvement in retail trading requires addressing these psychological and behavioral layers of decision-making. Whether through rigorous self-reflection or external algorithmic constraints, the mental game simply cannot be ignored.
Exactly. For everyone listening, it's crucial to connect the dots within your own trading practices. Are your repeated errors mechanical or are they cognitive? There is so much more to explore regarding behavioral finance, prospect theory, and how our minds process risk.
Challenge your own assumptions and perhaps calculate the actual dollar cost of your most frequent emotional mistake. The hard number might surprise you.
The diagnostic landscape for trading psychology will never be perfectly clean. The waters will always remain a bit murky. The question is, what tools will you use to navigate them? We leave it to you to decide which approach serves your trading best. Keep examining the evidence and keep challenging your own perspective.